Copper's taken a tumble in the last couple of days. Some have doubts about the strength of Chinese demand. Set against this, there's the improving supply picture and a jump in inventories. Let's get some more now on this. Also, the price of lithium, and also tuck in a Bitcoin comment as well with John Meyer from SP Angel. John, welcome. Let's park Bitcoin to one side just for a last couple of questions in just a moment. But I want to start off with this copper point because copper has taken, I think, its biggest one-day fall it's seen in 2017. And there are these sort of competing dynamics going on here within the market. What are your thoughts on it?
Well, we were surprised to see the price come back, and copper had been climbing very steadily. It was just nudging up against $4,000 a tonne, which I think is a good level for it. We do see the price going much higher next year, but the price has pulled back, and there's two things here. There's a rise in inventory levels, and we think investors should discount that. The market isn't about inventory levels anymore. There are big players who can manipulate those inventories, the big holders in the West, plus the State Reserve Bureau in China, well known for chucking a bit of copper in when it suits them if they want to push the price down. But I think what's been going on here is hedge funds like to square off their positions ahead of Christmas. They reduce their risk. They've been big players in supporting prices, in anticipating where the copper market is going. And I see this as really just a whole group of hedge funds pulling back their risk positions, selling a bit of copper just as part of that, and that's pulled the price back to just over $6,500 a tonne. So not a collapse by any means, just a bit of a pullback.
Yeah, talking about where the price is and where it's likely to go, just remind us your argument for suggesting that we have more upside than downside to go in the price of copper.
Well, this is about the electric vehicle revolution that is ahead of us, and I think is universally accepted or going that way. And more electric vehicles will use more and more copper. We'll need more copper for powering those vehicles as well as within those vehicles as well. And it's big tonnages, so there's no lack of demand going forwards for the metal, and it's quite difficult for the miners to find new copper mines. It's very, very difficult now for them to expand those new copper mines because they've done all that expansion in previous years, previous cycles. So, if anything, I think it's going to be difficult for the industry to keep up with demand.
Have you any idea as to where it's going to go from here? I mean, we're knocking on the door against what says 65, 64 at the moment, at 6.4. How much higher? Do you have a view on price?
Well, there are commentators talking about $10,000 and $12,000 a tonne. I'm not going to get into that game of leapfrogging my competitors. I would say, for me, breaking 7,000 is simple early in January. I think we'll see 8,000 next year, and then we should be climbing forwards to $9,000 a tonne very easily. I think, yes, there's good opportunity for the price to spike to $10,000 a tonne. I don't think we're going to see that next year, but I think it will come over the next 5–10 years.
You spoke about the electric vehicles behind some of this, if not all of it, potentially. What about the lithium market? Because lithium is we've been hearing a lot about lithium in the context of the batteries that will charge and fuel and drive these electric cars. What about the lithium market? Is that going to be as responsive positively?
Well, I've just been writing a piece on this, and I'm backed by another analyst who's an expert in lithium supply and demand, and we poached from another expert group, and we do see the market as working with a deficit in lithium for some time. The producers are struggling to keep up with demand. In fact, they're way behind the demand growth that we're seeing in China, and we don't think they're going to catch up for quite a long time. The key questions for investors are, well, how do they choose what type of lithium to buy into? Do they buy a lithium brine, lithium clay, lithium pegmatite producer? Where do they invest? What countries are safe for investment? For me, I think it's the hard rock stuff. It's lower capital cost. It means it's less risk. It's got a higher operating cost, but I still think that's a better way for most investors to go. And you know, there are different ways of looking at this market. A lot of fund managers are very worried that battery chemistries are going to change. For me, lithium is a lightweight metal. It's good at storing electrons, and those two things mean that it's going to be very hard to substitute lithium with something else. Yeah, sure, maybe in 10 years, 20 years' time, somebody might come along with a different chemistry. But for me, the chemistry changes now are going to be small and the sorts of things that will just help the storage capacity and production of batteries going forwards.
Yeah, you mentioned China a lot in the context of copper. Is China the main driver of the price and demand there from China for lithium?
Yeah, well, it will be for the next few years, because China as a communist state is very good at rolling out these countrywide, nationwide policies. What Beijing says must go, and so they are pushing the drive to electric vehicles out towards the regions very quickly. In certain cities are adopting it faster than others. And for example, there are over 22 million electric bicycles in the market already in China. That's a huge number, way ahead of any other country in the world. And I think electric taxis and even probably new autonomous vehicles will roll out much faster there than we'll see in the West.
And of course, one of the reasons why they're doing this is because of the increase in pollution. I know that going electric, of course, means you can help the pollution that's being experienced in some Chinese cities. I noticed as well, something that you headlined was that you're noticing that some of the big furnaces are being, I believe, now turned off in China. Is that right? To save these pollution factories, if you like.
Almost unbelievably, the Chinese have just pulled the plug on some of the big ferroalloy producers. These are the guys that produce ferrochrome, ferrosilicon, those sorts of alloy materials. They're big polluters, but they're also huge consumers of electricity. So they do two sorts of pollution. One, they've got open furnaces that just vent straight into the atmosphere, but also they take a lot of electricity which is produced by burning coal. That also pollutes the atmosphere, and the Chinese have asked these guys to cut back on what they're doing. I suspect the local ferroalloy producers have been resisting, and the authorities have just got fed up and literally pulled the switch and pulled the plug on these guys, and they are now shut down in certain states until they get turned back on again, and I suspect that runs through December and January.
What's the effect of that in the metals markets that will be affected directly by turning off these furnaces?
Well, for example, anyone who's been buying ore to feed those furnaces won't want to buy any more for a while. That will then flood the local market where that ore is produced. So maybe in the case of ferrochrome, the South African market might see a surplus of ferrochrome, of chrome ore material. That will reduce the chrome ore price. That would be very good for the local ferrochrome boys, but not so good for the guys mining the ore.
Yeah. Let's steer the conversation very briefly round to Bitcoin. I'm hearing that some resource companies are now beginning to look at Bitcoin, want a bit of the action. And I think actually I'm right in saying that one small company in Israel has now gone into Bitcoin, investing it like it is a commodity. As a mining man, do you see Bitcoin as a commodity, or is it a currency? Well,
the first thing to get straight is Bitcoin mining is nothing to do with the mining that we're involved in. And the second thing is, I was moderating a couple of panels at a mining conference this week, and at both of those panels, one was on gold and the other was electric vehicles, the fund managers were saying that bringing up Bitcoin as an issue, and that people investing in Bitcoin was taking money away from investment in gold and investment in other parts of the market. That's seen as a bit of a liquidity issue for them, but I wouldn't see that as a long-term thing. If you look at Bitcoin, it's something that exists in the ether. It's not a commodity in the way that gold is. Gold is fundamentally useful in electronics, in jewelry, and has been accepted as a store of value for thousands of years. Bitcoin hasn't existed for very long. It doesn't have any other use other than trading as a form of currency. Whether it stays or goes, it's not going to replace gold as a commodity. So I still see gold as more valid to me than something like Bitcoin.
So do you see the small drop we've had in gold recently being exacerbated by this move, but ultimately gold higher?
Well, certainly the fund managers seem to think that's what's been going on. It's drawn some liquidity out of the gold market, but I'm not convinced that's a long-term thing.
Yeah. Gold prices, do you have a view on where gold will be going in 2018?
Well, we're now beginning to see quite a lot of inflation coming through into the system, so it wouldn't surprise me if gold went to $1,350, $1,400 a ton, sorry, an ounce, and maybe higher. I think, you know, gold has always been a good hedge against inflation, and inflation is now at last coming through into the Western world. Yeah,
okay, something to watch out for. John, thanks indeed for joining us. John Meyer is mining analyst and co-founder of SP Angel here in London with a view on the mining market.